Have you ever heard friends talking about buying stocks in, say, Apple or Tesla and just kind of nodded along, wondering what on earth they're actually talking about? Well, today we are pulling back the curtain and demystifying the stock market, right from square one. Let's break it all down. You know, at its heart, it's a really simple idea, but it gets buried under all this confusing jargon and these complicated charts. So let's just cut through all of that noise. What if I told you it has less to do with finance bros and more to do with, well, pizza? No, seriously, a whole entire company can basically be thought of as one giant pizza. And if you can get your head around that one simple idea, you've got the key to understanding everything else we're about to talk about. So let's dive into our first section here and make this official. When you buy a stock, you are literally buying your very own slice of that company's pie. And that's the absolute core of it, right there. A stock is not just some number blinking on a screen. It's a real piece of ownership. You're not just, betting on a company to do well. You are literally becoming a part owner of that business. Now, in the world of finance, that pizza slice has a name. It's called a share. So when you hear someone say they bought one share of a company, it just means they took one slice of that entire corporate pizza for themselves. And here's where it gets really tangible. Let's imagine a company, pizza, is cut into 100 slices, or shares. If you buy 10 of them, you own 10% of the whole operation. Simple as that. Now, of course, a massive company has millions, sometimes billions of shares. But the principle? It's exactly the same. Okay, so that's the what. But now let's get into the why. And to do that, we're going to follow the story of a little startup coffee shop to see why selling stock is so important for businesses that want to grow. It seems a little weird, doesn't it? If you build a company from the ground up, why would you want to sell pieces of your dream to a bunch of strangers? Well, the answer is actually one of the most powerful forces in business. It all comes down to raising money, what the pros call capital. Growing a business costs a lot. And instead of going to a bank and taking out a huge loan that you have to pay back with interest, a company can sell shares. That money doesn't need to be repaid. It's cash they can use to build, to expand, to invent. And this story just illustrates it perfectly. So our entrepreneur, Alex, has a fantastic idea for a coffee shop, but she's short on cash. So what does she do? She sells a piece of her future company to an investor named Sam. Now Alex has the full 200 grand she needs to get started, and Sam, he now owns 10% of her new business. It's a win-win. So Sam's put his money on the line. What happens next? This is where things get really interesting. It's where the magic and, the risk of the stock market really comes into play. Let's jump forward 3 years. Bean & Brew is a huge hit. The company that was originally worth $200,000 is now valued at $500,000. So Sam's 10% stake, the one he bought for 20 grand, is now worth $50,000. If he decides to sell his shares, that's a $30,000 profit. His belief in Alex's coffee shop really paid off. But, and this is a huge but, what if it didn't work out? This is the other side of the coin, and it's absolutely crucial to understand. Every single investment comes with risk. The potential for a big reward always comes with the possibility of a loss. So the key thing to get here is that your shares value is tied directly to how well the company is doing. If Bean & Brew had struggled, maybe the competition was too tough, and its total value fell, well, Sam's 10% stake would suddenly be worth less than what he paid. He'd lose money. Now, if we zoom out from our little coffee shop, this basic dynamic is what drives the entire stock market. The price of any share on any given day is just determined by this simple tug-of-war. Are there more people who want to buy it or more people who want to sell it? It really just comes down to supply and demand. Okay, so you think a stock is a stock, right? Well, not exactly. It gets a little more nuanced. Think of it like booking a flight. Not all tickets get you the same seat or the same perks. The same is true for stocks. Let's just break down the difference here. Common stock is like your economy ticket. It's what most people buy. It gives you voting rights in the company, so you get a say, and its value can absolutely skyrocket. But it's also riskier. Preferred stock is more like business class. You usually give up your right to vote, but in return, you often get guaranteed payments called dividends, and if the company ever gets into trouble, you get paid back before the common stockholders. So it's more stable, but usually has less explosive growth potential. Okay, we know what a stock is, we know how it works, but what does this all mean for you? How should you actually think about investing? Let's talk strategy. And look, this is a really fair question. I mean, your money in a bank's savings account is pretty much guaranteed to be safe, right? So why on earth would you take the risk of putting it in the stock market? The answer really comes down to just one word: growth. This chart right here is the reason people take that calculated risk. Historically, over the long term, the stock market has offered much, much higher returns than a typical savings account. And that big difference you see? That's the potential reward you get for being willing to ride out the market's inevitable ups and downs. So when you do decide to invest, there are really two main ways to play the game. You've got traders who are constantly buying and selling, trying to predict short-term price swings. It's incredibly difficult and very risky. Then you have long-term investors, like Warren Buffett. They buy pieces of great businesses and just hold on, letting them grow for years or even decades. For almost any beginner, that long-term approach is by far the smarter, more reliable path to building wealth. And as you get started on that path, if you remember just one thing from all of this, let it be this. This is the golden rule of investing. Never, ever forget it. This idea is called diversification. It's the old saying, don't put all your eggs in one basket. Instead of betting everything on the success of just one company, you spread your money across many different ones. That way, if one of your investments hits a rough patch, the others can help cushion the blow. It's your financial safety net. And it's easier than it sounds, too. Many people do it by investing in things called index funds, which are like pre-made baskets that hold tiny pieces of hundreds of companies all at once. So we've gone all the way from pizza slices to billion-dollar markets. A stock isn't just a number on a screen. It's ownership. It's a piece of a real business with real people and real products that has a vision for the future. And that means the question you should be asking isn't just, what stock should I buy? It's something much more powerful. What future do you want to own a piece